Hey everyone, it's Mark Ferguson with Investor More, and we're having a special video today because of all the big news happening in the world, and that is we had a big bank fail, and then news just came out that another bank failed, and we have news on how the federal government is handling these failures as well. So I made this video once, and then after I made the video, a bunch of more news came out, so I came back to add some more and redo some things. All right, so we had a huge bank fail, another bank fail, and then the federal government has decided how they're going to handle it. I'm going to talk about why the bank failed, how bonds play a role in that, how the federal government plays a role in that, especially with their hiking of interest rates, and if we really need to be worried about it or if it's an isolated incident. All right, love the likes, love the comments, love the shares, love to hear what you think about this issue as well. I am not an economist, I am not a banker, but I am a real estate investor, agent, and I have a business finance degree. I've had a lot of experience in the real world and talked a lot about interest rates and inflation the last year, as many of you know. Okay, so what happened? We'll get right into it. Silicon Valley Bank failed on Thursday, and basically they had a run on deposits brought on by fear that they didn't have enough money. And so basically what happened is this bank has been around 40 years, been around a long, long time, and its main client are startup companies fueled by venture capitalists. So lots and lots of money coming into these businesses. They don't really get a lot of loans, but they have lots of cash. And the preferred bank, apparently, to store this cash is the Silicon Valley Bank for these startups, these companies. And a lot of them are more than startups, they're big companies now. And they put their cash into this bank. Well, earlier this week, the bank had to sell some bonds, and then there was a lot of concern they were running out of money, and a bunch of people, of companies, tried to take their money out. And in fact, a huge amount of money was taken out of the bank, and they were able to give a huge amount of money back to the depositors, but just not enough. The federal government came in, shut down the bank, took it over. Now they may sell the bank. I'm not exactly sure what's going to happen there. So the way banks work is, as a person and company, you are guaranteed up to $250,000 per owner of accounts at a bank. So if you have 20 accounts or one account, it doesn't matter. You're allowed $250,000 of protection from the FDIC. So if a bank fails and you have $500,000 in the account, the government says, we'll make sure you have at least $250,000. We'll pay you that. The rest, well, probably not going to get that back. And it turns out there were companies with $50 million, hundreds of millions of dollars maybe in this bank, maybe even more than $1 billion from one company, and they were only guaranteed up to $250,000. So you can imagine they're freaking out. There's been lots of worry that these companies might fail, they can't meet payroll, all their cash is gone, and they won't be able to continue with business. Now, a lot of these companies had multiple banks they worked with. They didn't keep all of their cash in one bank, which is how I think is the safe way to do things. But there's a few that had a huge percent of their cash in this bank and are very worried about it. So what happened? Why did this run-up happen? Well, a lot of it stems from the federal government and interest rates and the way this bank operates. So, like I said, there's a lot of cash going into this bank, but they don't produce a lot of loans. A lot of these startup companies, big companies, don't need loans. They've got all this cash coming from venture capitalists, so they're not a big lender. A lot of other banks, big banks, Bank of America, Wells Fargo, have lots and lots of loans. That's how they make their money. So a bank takes in your deposit. They pay you a small percent on your deposit. They get this money, and they take the money and they lend it out as a loan, or they invest it in some way so that they can make money, right? That's how banks make money. It's a difference between what they're paying the depositors versus what they invest the money or loan out as, and then they make money in that way. Now, the bank doesn't have to keep all your deposits in cash. It's called fractional banking, where they can keep some of your deposits and lend out more or invest more of that. And so they don't always have, if they have $200 billion in deposits, they don't always have $200 billion of cash at the bank. They would be impossible for them to make money that way unless they charge people, right, to hold their money. Instead, they're paying people out, so they have to lend it to make money in that manner. So in the last few years after COVID, they just got a massive amount of deposits. There's all kinds of cash coming in, lots of venture capitalist money going in to the area, and they got lots and lots of deposits. Now, they weren't making loans, so they said, hey, we'll buy bonds, treasuries, safe stuff, a lot of it from the government. The thing was, they're only making like 2%, 3% on these safe investments, but they're only paying, the depositors 0.5% or who knows what that is. So they're still making money, but it's very low percentage return bonds. Well, the federal government in 2022 decided inflation was too high, or the Fed banks are basically the same thing, but inflation was too high. They said, we're raising our interest rates up. We're going to take care of this inflation. Well, I've got lots of opinions on that, which a lot of you know. I don't know if that's always the best route because it causes a whole lot of issues for a whole lot of people when you make it expensive to borrow money. Raises the cost on everything because most people use loans or have, different ways to make money that uses companies that use loans. It makes costs increase, basically. And so we've had a lot of supply issues. And when you raise interest rates, it doesn't do anything for supply issues. It makes it harder to produce supply. It restricts demand. And instead of fixing supply, we restricted demand, which, anyway, we're in a pretty big mess right now. But that's another video, another story. So what happened with the raised interest rates by the Fed is if you have bonds, so let's say you have a bond, we're going to say 5% interest rate just to make it really easy. A bond for 10 years at 5%. After the 10 years, the bond company or whoever issued the bond, the government will pay you back whatever your investment was, $1 million. So you hold it for 10 years, you get your 5% interest rate. At the end of the 10 years, you get all your money back. Well, bonds are rated on how good the company is. The federal government usually rated pretty good. Real small companies, maybe they have junk bonds, they aren't as good. You get higher rates for the more risk you take on. You're thinking you're getting government bonds, pretty low risk. Well, if you hold them to maturity, it's fine. You got the return you wanted, no issues. But with this particular bank, they were getting low on cash to meet their deposits to have enough safeguards. So they had to sell some of these bonds before they wanted to. They weren't able to hold them for the whole maturity and get the return that way. And when interest rates went up, that same bond they bought that was paying 2% interest rate a couple of years ago, now maybe it's paying 4 or 5%. And nobody's going to buy a 2% bond when you can get a 4% bond at the same price. So what does that mean? That means those bonds that they bought, they had $1 million bond that paid 2%, but someone can get $1 million bond that pays 4% now. Their $1 million bond is now worth $500,000, or, it can be based on the years left. All kinds of different things can factor into that. But basically, the value of their bonds decreases significantly. And if they're forced to sell them before they mature, they take a huge loss. So they took a huge loss on these bonds. That scared a lot of people. I think a lot of people thought they were running out of money. And then a lot of people ran to the bank, tried to get all their deposits out, and something like $41 billion in cash was paid out to people trying to get their money out. But that wasn't enough. They ran out at about 41, 42 billion. After that, they were out of money, out of cash. Once that happens, the federal government comes in, says, you're done, we're taking over, you're insolvent, and we will make it all better from here. Now, the really interesting thing about the bonds and different things that the bank was investing in is if the federal government issues these bonds, and they issue a lot of them because they spend a whole lot of money and need to get that money from lots of different places, including printing money. But when they raise interest rates, so let's say their bond is worth $1 million right here, they raise interest rates. This is money the government owes to people, right? At the end of this term, they'll owe this money. Well, they'll have to pay back that $1 million at some point. But if they raise interest rates up to here, all of a sudden the bond over here is worth a lot less down here. So they're able to decrease the value of the own money, of the money they lent out. So it's like me borrowing $100,000 from someone, then I decide to raise interest rates for everybody. Now I only owe them $50,000. Now technically I'd still owe them that money at the end of the term, but I mean, what if I say, hey, okay, my own bond that I lent out to you is now worth $50,000. I'm just going to go buy that bond back at a discount, save myself a whole bunch of money. Now I don't know for sure if the government's doing that or not, but that's just something that popped in my head when all this was going on. So the bank went under. Another bank, well, after I made my previous video that I'm redoing right now, SIgniture Bank also went under. A second bank was taken over by the government. So That has a lot of people worried. A lot of people are wondering what's going to happen with these companies with this money. Some people are saying you have to bail out the bank. Some people are saying no, let it fail. Well, the government came out and said what they're going to do. They are not going to bail out the bank. They're not going to bail out the shareholders, but they are going to pay everybody back all of their deposits. So if you had a $500 million deposit in the bank, the federal government swooped in and said, don't worry, we'll have your $500 million for you on Monday or tomorrow, whenever you're watching this. And so all of those companies, all those people are getting all their money back. There's some questions and concerns there about if this is going to be an ongoing trend, right? Did they just change all the rules for guaranteed banking? Is everybody's deposit now guaranteed at any amount for any bank? Or is this a one-time thing? If it is a one-time thing, seems like, why are they getting special treatment? I don't know, but those are lots of questions that we will see here in the future, and who knows how they will be answered. Now, of course, the federal government said that this won't be taxpayers' money that they're going to use to pay back people. I don't know what money it will be if it's not taxpayer money, unless they decide, oh, we're just going to turn on our printing presses again and print more money. At the same time, while they're trying to fight inflation by raising rates, then they'll just print more money, which will increase inflation again. And then, oh, well, we just have to raise rates again to fight that inflation we just caused before. Again, speculation on my part. But there is some other speculation, too, that because this happened, the federal government or the Fed Bank will lower rates. There's some speculation that says if they want to avoid this happening over and over again, other banks that have heavy bond exposure, invested a lot in bonds, they might be at risk of failing too. Well, the way for the government to save those banks and keep that from happening is to lower interest rates, raise the value of those bonds back up, and that will save a lot of the banks. Will they do that? Who knows? Maybe their new strategy is we'll let them fail and we'll just pay everybody all the money that we print. I don't know. So it'll be interesting to see what happens here in the next couple of weeks, couple of months with all this, with interest rates, with different banks, with this particular situation. I think it definitely has thrown a bit of fear and questions into the market, especially the stock market and different things. Lots of banks saw huge declines in value the last couple of days. There's some questions about real estate. What will happen with it? Real estate is very slow right now. Houses aren't selling as fast. Businesses aren't selling as fast. Commercial properties aren't selling as fast. But there's no massive crash. There's no massive price drops because with the increase in interest rates, not only do you have demand dropping, but you have supply dropping too. And not to mention demand was up here. Supply was up here before interest rates dropped. So even if demand drops, I still don't think it dropped below supply. There's a lot of things to think about there. But building has come to a halt once interest rates goes up. That drops supply. Home sellers decide they don't want to sell. They're not going to lose their great interest rate to get a gigantic one. So that has slowed down. So the market has come to a standstill, which is what happened in the 70s and early 80s. Prices kept going up. Prices tripled in the 70s, even with rates doubling. It was very slow. There wasn't much going on. Building slowed down a lot, but there was no crash. So it'll be interesting to see what happens. The Fed and Senator Warnick, I know I probably have that completely wrong, got into a discussion. Powell and Warnick, I think that's his name, but I forget if he's a senator or whatever. And he was asking him, hey, do you know that when you raise interest rates, it makes housing more unaffordable for people? And Powell said, yes. He's like, okay, and what's your goal with raising interest rates in housing? And Powell said, well, I want to slow down inflation. Not that I want to drop prices, not that I want to cause a crash. I just want to slow down inflation a little bit. And he said, I think we've done that. And he's like, well, you slowed down inflation, but houses are less affordable now because rates are so high than they were before that. And if you're not trying to drop prices or lower them, what is the point of that? And he just kept saying he wanted to slow it down. And then Warnick brought up some other good points of that, hey, when you did this, building slowed down. When you did this, sellers don't want to sell. When you did this, it made it more expensive to produce things because money is more expensive and the cost of everything goes up. And Powell said he agreed with all that, but he stuck to his guns that we're trying to slow down inflation and that's the best way to do it. So housing, I mean, if they lower interest rates, I think that will definitely cause an increase in housing activity, an increase in sales, and it could even push prices up again. We need more houses. We need more houses to be built. There's not enough of them out there. And just because you make people not owners of houses or you want to discourage them from buying houses doesn't mean they can't go live on the street. They still want to live somewhere, then they become renters. And the way they calculate inflation right now, housing is a huge factor in it, and rents are how they calculate it. And this is crazy. You probably won't believe me. They don't use mortgages or they don't use house sales. They use what homeowners think their house will rent for if it was to be rented. That's how else they calculate inflation in houses. Not look at sales prices or what mortgages cost. They ask the homeowners what they think their house will rent for, and that's a huge part of their calculation on inflation. So a few experts have said it's absolutely crazy they do that, but that's how they do it. Inflation went up a little bit higher than they expected in January, mostly because they changed the way they calculate inflation, which they do a lot as well. So it's the more I learn about the Fed and the way they do things, the less confidence I have in their ability to do things. But again, I'm getting onto more of a tangent that I want to. Housing, I don't think, is in any crazy danger. Tons and tons of banks collapse. It could be, but it still won't solve the housing inventory problem of there not being enough houses. So, and if all those banks do collapse and a lot of crazy things happen, they're probably going to drop interest rates a bunch to try and save things. And if that happens, there's still going to be a lot of people with money who are going to be able to buy properties, and they will buy properties. As far as the other markets, as far as banking, who knows? I don't think a bunch of banks are going to fail. I think these were kind of specialized banks, smaller banks that had a lot of bond exposure. But again, I'm not a banking expert. I've just been listening to a lot of other experts, trying to gather what they say and regurgitate it to you a little bit. So we'll see what happens from here. This bank was at $209 billion. The threshold for more oversight is $250 billion. So had they been just a little bit bigger, they'd have stress tests from the government, more oversight, and maybe they could have prevented things like this. However, when you look at how much cash they paid out, over $40 billion, it's like, would a stress test have even caught that? Or would the government have been like, yeah, you're good. If you want to pay out, if you can pay out $40 billion in cash, you're probably going to be okay. But there's just an unprecedented run on cash at this particular bank. A lot of questions to be asked. We'll see what happens. The federal government has stepped in, decided it's more important to save these companies and give them their cash back than to stick with their actual guidelines are. Again, I don't know what to think about that yet. I don't want to give an opinion one way or another, but I'd love to hear what you think on that. Seems like they make these rules for a reason, and then a lot of times the government just comes along and arbitrarily breaks those rules, which sets precedent for the future of people not knowing what to do or how to handle things, and that usually creates bigger messes. But again, I guess we'll see what happens. All right, love to hear what you think. Love to know if I was wrong on anything that I said from the real experts out there in banking or the economy and different things. And of course, love seeing new subscribers as well. So most of my videos are of our flips, renovations, rental properties, commercial properties I own, businesses I own, things like that. But this was a pretty interesting thing that happened here over the weekend. I wanted to chime in and give my opinion, and then we'll see what happens from here. All right, thanks for watching. Be back soon. Love to hear what you think.